All right, so in this video, we're talking about line number 7 of the 1040. So this is part of the line by line series where we're going through and we're working through every line on our 1040 in order to allow you to have additional context with those lines, or if you're working on the tax return yourself, that way you know what's going in those lines and you're not missing things. So when we look at line number 7, what we're dealing with is capital assets. So capital assets are going to result in capital gains or capital losses. Now that's different than what we're dealing with when we're looking at dividends. Dividends is based on some kind of ownership interest in an entity. When we're looking at a capital gain or a capital loss, what it is it's the sale of a capital asset. So we have to have sold something in order to have a capital gain or a capital loss. If we sold it for more than our purchase price, usually that's going to be called our basis. I have a video that walks you through the basis. If we sell it for more than our basis, then what we're going to do is we're going to have a gain. If we sell it for less than our basis, and what we're going to do is we're going to have a loss. All right, but it's based on the sale of a capital asset. So when we're talking about a capital asset, what we're talking about is either an investment. So if you sold your stocks or if you sold your bonds, those are going to be examples of capital assets. Or let's say you sold your rental property. That's going to be the sale of a capital asset. Or maybe you're selling an individual asset, a personal asset, such as your home. Well, those are also going to be capital assets. So investments in personal property are going to be capital assets. And when you sell those, you're going to have a capital gain or a capital loss. So in this video, we're going to walk through the process of how we handle those types of things. Now, what we'll do first is we're going to take a look at line number 7 on the 1040, just so we can orient ourselves with where we're at. And then we'll start going through and looking at what specific assets are qualifying as a capital asset so we can determine whether we even have capital gains or capital losses. So let's go ahead and take a look at the 1040 right now. All right, so here's what our line 7 looks like on the 1040. So what we're dealing with here is our capital gains. Now you can see that it's mentioning the Schedule D. So you may be required to go ahead and do a Schedule D. Like I said, video number 2 on line 7 is going to deal with our Schedule D. So if you do have capital gains and you're trying to figure out how you calculate it, or you're looking at your return and you have those capital gains, you can start to understand how you can interpret where those numbers on line 7 came from. Because line 7 is going to be where we place those numbers. It's where the numbers live. But the work behind the scenes is actually happening a lot of times on our Schedule D. So that's the direction that we're heading. Like I said, Schedule D and more of a problem base is going to occur on that second video. But let's go ahead and start seeing what type of things will be appearing for line 7 so we can determine if we even have anything that is line 7 worthy. All right, so let's take a look at what capital assets are. Now this table you're looking at has a bunch of different capital assets on there and a couple that aren't capital assets. So when we're looking at capital assets, we know they're going to be investment property or they're going to be personal assets. So stocks, right? You sell your stocks, you sell your bonds, crypto, those are all going to be considered capital assets. If you have a home, your personal residence, you sell that, that's a capital asset. So now there's going to be additional rules with the personal home because there are some exclusions where you may not have to pay taxes on your complete gain that you make on a sale of a personal home. $250,000 if you're single, $500,000 if you're married filing jointly. But a personal home is a capital asset. Investment in real estate is going to be a capital asset as well. There are certain things that it's not, though. So inventory, accounts receivable, your business asset types of things go a little bit different because you're going to have 1231 assets on that one. But we're looking more at it from your 1040 or personal tax return. So inventory, accounts receivable, we generally consider those hot assets, and they're going to be resulting in ordinary income. They're not going to be giving you the capital gains rate or the capital loss if you have a loss on a lot of these things. So that's what we're looking at for capital assets. So let's go ahead and start figuring out if we're going to have a gain or a loss, because there's a formula. We have to figure out, okay, what was our basis? And then do we sell it for more than our basis or less than our basis? So let's take a quick look at the formula so we can start to understand, all right, do we have that gain? Okay, to get to line 7, we know there was an asset that was sold. It was a capital asset, but now we have to figure out whether we have a gain or whether we have a loss. So to do that, we have to look at a formula. And the beginning part of the formula is, well, what did we realize upon the sale? So how much did we get? Now, it could be something simple as though you have a $200,000 house, you sold it for $250,000. The amount that you realize is going to be $250,000 because it's what you're actually going to be receiving there. However, it's not always as easy as looking at the amount that you actually received. Because there are going to be different types of things to where it could be debt forgiveness, It could be some other type of property in addition to cash. So there's different types of ways that you have to look at it. It falls outside the scope of what we're dealing with, but in many instances, what you're looking at is going to be the cash that you received, and then perhaps some forgiveness of debt if somebody else is assuming your debt. All right, so that's the amount that we realized on the sale. Then what we're going to do is we have to go ahead and we have to subtract out our basis. Okay, so we're going to take our adjusted basis. Now, what does adjusted basis mean? So generally, basis is going to be what your purchase price was for an item. There are different ways to get to basis. It could be something like you inherited it and then you take the fair market value at the time of the inheritance, unless you took the alternative valuation date. But those things start to complicate things, or gifts. Those can complicate things. What we're looking at for purpose of this video is generally what you paid to purchase the item for. And then you may have made improvements over the life of the asset. So if it's your personal home, you may have made significant improvements. Maybe you put in central air conditioning on it, right? Maybe you built a deck. Those things are all going to be capital improvements, and that's going to increase your basis in the house. So it was an investment into your house. So what we're going to do is we're going to subtract what we're receiving minus how much we've invested into this house, and that's going to give us our capital gain or loss. Okay, so if our amount that we received is greater than what we've invested, our adjusted basis, then what we're going to have is we're going to have a capital gain. However, if we have an amount that we received is lower than what we've paid for it and invested into it, then we're going to have a capital loss. So if our home is worth $200,000 that we've invested into it, we sell it for $300,000, we have a $100,000 capital gain. If our home is worth $200,000 and we sell it for $170,000, we have a $30,000 capital loss if we receive that $170,000. All right, so let's go ahead and let's move on from here, and let's start looking at the next part. All right, when we have the sale of a capital asset, then what we have to determine is whether it was short-term or long-term. So for tax treatment, are we going to have a short-term gain, or are we going to have like a long-term gain? Now, here's the rules for it. If we've owned it for 1 year or less, then what happens is it's short-term. And short-term can be kind of brutal when we're talking about gains, because we're going to be taxed at our ordinary tax rate. And the ordinary tax rate, the maximum tax rate, is 37%. So if we're making a lot of money, maybe we're going to be taxed at 37, probably going to be taxed a little bit below that though, right? So we're going to be taxed at our ordinary tax rate. Now, if we've held it for 1 day more than a year, so more than 1 year, then what we do is we have long-term. Now the long-term is going to be great, because if we have this gain, what's going to happen is that gain is going to be a capital gain. And our capital gains rate is going to be 0, 15, or 20%. So it's a favorable tax rate. So that 1 day difference can be a significant difference in the amount that you're going to have to pay in taxes. So if you're selling a capital asset and you're right around that 1 year period, make sure you cross the 1 year. So at least 1 year and a day. So that way you're going to get capital gains rates, which is generally what we're looking for. All right, now that we know what short-term versus long-term is, what we have to do is we have to worry about the netting process. Now, I'll cover this in greater detail on our Schedule D video, but what we're going to look at right now is just kind of the general conceptual framework that we're using when we use this netting order, the netting process. So here's the steps we first take. We're going to net all of our short-term gains and losses, right? So if we have short-term gains, we're going to look to see, do we have any short-term losses? And if we do, we offset them against one another. So our losses will be compared against our gains, and we'll come out with a net number. We'll have either net short-term gains, or we'll have net short-term losses. There'll be one number, and it's going to either be positive or negative. Then what we do is we go over and we do the same process, but now we're dealing with long-term gains and losses. We're going to net the losses for long-term gains and losses to one another. We're going to come out with whichever one was greater. So if we had, say, $3,000 of long-term gains and $2,000 of long-term losses, well, our gains are greater than our losses. So if we subtract those two together, what we have is $1,000. So we're going to have net long-term gains of $1,000. So that's what will survive in our step number 2. That's the same process we did for step number 1. Now what happens is we take step number 3 and we say, okay, So we have one number left for short term. We have one number left for long term. So what we have to do is, if they are opposite signs, one's a positive, so one's a gain and one's a negative, then we do the netting process between those two as well to figure out what the surviving amount will be. It'll be one amount. It'll be either a capital gain or a capital loss, right? We're going to net them against each other. If they're separate signs, then we're done with the netting process in that regard. So those are the amounts that are going to eventually flow to line number 7 on our 1040. So what we're going to do is we're going to go ahead and we're going to look at some examples. But before I jump over to the examples, I do want to mention one thing. Let's say that you have losses that survived. You've netted everything and it's going to be a loss. So what do we do with our losses? Well, if we're an individual, we can take up to $3,000 of those losses, and we can go ahead and offset ordinary income by that three. So we get to recognize that $3,000 of losses in the current year. Okay. If we had more than $3,000, maybe we had $5,000 of net losses. If we had more than the $3,000, anything in excess of $3,000 will be carried over to the next year. And then we'll go through and we'll see if we're able to use them on the next tax return. So we don't lose them. We're just not going to be able to use them all in this year. But let's go ahead and let's look at some examples as we're going through this process. All right, so here's some examples for us. So on the first one, let's assume that we only have one single transaction during the year. And what we're going to do is we're going to purchase stocks for $5,000 and we sold it for $9,000. Well, what's going to happen? The $9,000 versus a $5,000, that's going to go ahead and give us a $4,000 gain. Now, is it going to be a short-term or long-term? It depends. If it was held for over a year, we're going to have a long-term gain. If it was held for, say, 8 months, now we're going to have a short-term gain. All right, so let's go ahead and see another one where we have a gain and a loss. Now we have a $6,000 gain on one sale and a $2,000 loss on the other sale. So when we go through the netting process on this, what's going to happen is we're going to take the $6,000 gain and we're going to subtract out the $2,000 loss, and we're going to go ahead and have a $4,000 gain. So that's the netting process. Now, what would like to happen, we'd want to go first and say, you know, was this long term or was this short term? Because our first step is always going to be netting the short terms against each other and our long terms against each other. But if these are our only two transactions, then we're still just going to jump over to step number 3, even if they were, one was long term and one was short term, because at that point we have to net them together. So the third one, the loss exceeds gains. All right, so we have $2,000 of total gains and $8,000 of total losses. Two opposite signs, right? So we're going to net those together. Now, what you might be thinking is, wait a second, 8,000 total losses against 2,000 total gains? That's $6,000. You're showing 3,000. I am. Because on line 7, what you're going to get is that $3,000. Because remember, just a little bit ago, I told you that if we have a loss, we're limited to $3,000 losses, and we carry the remaining portion of it forward. So we would carry the remaining $3,000 of losses forward till next year's return, and then we'll continue to carry forward until we can actually use that amount. So we haven't lost it. We just don't get to use it in the current year. All right, and if we were a corporation, by the way, hey, we wouldn't be getting to take this anyways. But this is for individuals, and that's what we're focused on with our 1040. Now, next one, long-term gain only. All right, so we've held assets held for 3 years, sold for $12,000 gain. We've held it for 3 years, over a year. We know it's long-term. We sold it for a $12,000 gain. That's going to be a $12,000 long-term capital gain. We're going to move that on over to line 7 if that's what the event was. And then what we'll get is our 0, 15, or 20% tax when we start getting to the tax rates and those things. Short-term only. So now we bought something 6 months ago. We bought it and sold it within 6 months for $4,000. Well, we have a $4,000 gain in that situation. Okay, so that's going to go on line number 7. Now, there are some other things out there that you want to be careful of, like wash sales and some of those types of things where you buy the same stock that you held. You buy it close in proximity to each other, so you may not be able to recognize some losses in those types of situations. But that's outside the scope of this video as well. But if you did have something to where you bought and sold stocks in the same year, the same stock, then you want to make sure you're reading up on wash sales before you go through this whole thing. Crypto. So you bought crypto for $3,000, sold it for $6,000, $3,000 gain goes on there. Okay, so crypto is the same thing. And here's a personal asset. You sold a personal car at a loss. All right, so personal assets are done a little bit differently. You have a personal asset, it's a capital asset. If you sell it for a gain, you have to pay taxes on it. If you sell it for a loss, IRS doesn't want to hear about it. You don't get to deduct a loss on a personal asset. Okay, so if you sold that car for a loss, doesn't matter. You're not going to be able to deduct it. Okay. Now, if you had a home and you say had a $300,000 gain on the sale of your home and you've held it and use it as your primary residence for the last 4 years, for example, then if you're single, $250,000 of that $300,000 gain isn't going to be taxed. If you're married filing jointly, you're not paying any taxes on that gain because you've had $500,000 that won't be taxed. So you only have a $300,000 gain, the ceiling of $500,000, you wouldn't even have to worry about the taxes on that. All right, well, let's go ahead then. And now that we know what's appearing on line 7, let's go ahead and look to see what the impact is going to be on our tax formula. Okay, and then we'll look at some mistakes that are commonly made. But that's going to be the steps we do. Now, if you want to actually see how these things are going to be calculated and things, again, that goes with our Schedule D video, which is where you see all the computations with these types of situations. All right. So when we're looking at line 7, here's why it matters. So like many of the other lines, it impacts our AGI. And we know AGI is super important throughout our tax system, right? Our adjusted gross income. Because AGI is going to be related to our tax brackets. Is going to help us determine whether we're itemizing, because if we're trying to itemize and we have medical expenses, well, we know that we can't start deducting any medical expenses until 7.5% of AGI. So our medical expenses have to be 7.5% of AGI or greater before we're going to be able to start to actually deduct those medical expenses. It also relates to Social Security. What portion of our Social Security is going to be taxed? So it's going to be up to the maximum of 85% of our Social Security. So it's used for that. And it's also determined if we're phasing out on any type of tax credits. So let's go ahead and look at some common mistakes that taxpayers make when they're looking at line number 7. All right, these are some of the more common mistakes that are made. First one's going to be ignoring the holding period, right? So that can also be a tax planning issue because we know there's a big difference between the tax rates if you have a short-term capital gain versus a long-term capital gain. So to get that long-term capital gain, you want to make sure it's over a year. And then at that point, you're going to get those favorable 0, 15, or 20% tax rates versus your ordinary tax rate. Other things is sometimes people finish their taxes and they think, okay, that's it. They put it away and they don't think about their taxes from the previous year. Well, that can be a mistake because if you had losses, you carry those losses over. And then when you have those losses, so like in the example we had, whereas I think we said $6,000 of total losses, we said you could use 3,000 of them in the current year against ordinary income. Well, what's going to happen is those other 3,000 will be used in the previous year if we're eligible for them at that point, but they carry forward. So you want to make sure that you're going to still be able to use them. So you want to remember what you had from previous years to carry that over. Rate confusion. Applying the wrong tax rates to it, especially when they're dealing with tax planning and trying to figure out, what the impact is on certain things. When you're looking at those long terms, remember 0, 15, 20%. So again, that's a tax planning issue for you, but it could be a reporting issue if you're doing it. Your tax program, if that's what you're using, will be catching what the tax rate is as long as you're putting in, what the period of your holding period was. And then reporting gross sales. So sometimes people will be like, okay, I sold it. This is how much I got. That's how much I have to pay taxes on, right? I sold it and my bank account increased by $12,000. So I have to pay tax on 12. Well, no. That 12,000, if it's gain, maybe so. But what you have to do is you have to say, well, what was my basis, right? My purchase price plus any improvements if it's depending on what type of asset it is. But if it's stocks or whatever, maybe you bought them for 9,000, you sold it for 12. Don't pay taxes on the 12,000. You only pay taxes on the 3,000. So remember to include basis. So when you're trying to figure out what your total gain is, you're able to not be taxed again on what your basis is. All right, so that concludes our line number 7. Now what I'm going to do is I'm going to go do a video on Schedule D because sometimes you're required to use Schedule D when you're going to be applying to line number 7. So we're going to take a look at Schedule D and make sure we're okay with that as well.